In this video, I would like to explain the tax burden that happens on the market when the government imposes a specific tax on production when the price elasticity of demand is smaller than the price elasticity of supply. So in the previous video, you saw I already reasoned how it works when the PED is greater than PES. Now I wanna change the scenario and do the opposite. What happens when the price elasticity of demand is smaller than price elasticity of supply, meaning that the suppliers are relatively elastic in their approach to changes in prices, whereas the consumers, the demand, is relatively inelastic. And we can see this graphically over here. So when the demand curve is fairly steep, we're having a relatively inelastic demand, and when the supply curve is relatively flat, we're having a fairly elastic supply. Hope this makes sense. Now, out of the tax revenue that the government collects, which is going to be the difference between the price that the consumers are paying after the tax and the price that the firms or the producers are getting after the tax, this amount of tax is being collected for every unit of the quantity taxed on the market, which is going to be QT over here. So therefore, out of this rectangle right now, what is the burden for the consumers and what is the burden for the producers? With a similar logic like we reasoned before, the burden is going to be higher on the entity on the market which are less sensitive to changes in prices, meaning that if we have a fairly inelastic demand, that speaks of the fact that customers are willing to incur higher prices. They're willing to pay higher prices for the products. As a result of this, we can see that they will incur a higher burden. This is explained logically, and this can be argued graphically right now. We can see over here that the price that they pay above equilibrium is going to be fairly high, and for all the quantity that they actually going to buy, which is QT, this rectangle is going to represent the burden on the consumers, which is a fairly big area compared to what producers have to incur. Since producers are more sensitive to changes in prices, they are not willing to adjust their production very much when they have to set a higher price on the market. So as a result of this, the burden that they have to incur is going to be smaller, which I'm going to shade with this rectangle in green right now. They're going to receive a price below equilibrium for the quantity that's being sold on the market, and it's going to be this green rectangle over here. So as a result, we can see that the tax burden for the producers, is going to be smaller than the tax burden on the consumers. Let me make that note over here as well. Tax burden on the consumers, because the price elasticity of demand is smaller than the price elasticity of supply. Consumers are less sensitive to changes in prices, and therefore they're willing to incur the larger effect of the tax on the equilibrium price on the market. Hope this all makes sense. I appreciate you all watching. If you like the video, please make sure to subscribe, and we are done.